My name is Shane Clifford. I am the head of global private wealth for Carlyle. And there's a lot that we can talk about over the course of what's hopefully more of a conversation than a Q&A today. Immediately to my left is Mark Sutterlin. Mark is the head of alternatives at Bank of America Merrill Lynch. Immediately to his left is Jeff Locke, managing director at Citi Global Wealth. And over on my far left is Michael Glennon, VP, head of private investments at Mariner. So I think you've got a fair representation across the wirehouse bank and RIA side, along with a manager here in front of you today. So awful lot to discuss. I've been getting a lot of questions as I've walked around and post Harvey's comments this morning with regards to Carlyle's commitment to the private wealth space. So I think there's a lot that we can kind of get to here. Perhaps just to open it up, I would say, private markets and kind of where we see them going at Carlyle. From our perspective, it should be noted that we've been in the business since the early 2000s. About 10% of our flows today are already coming from the wealth channel. We have ambitions as to where we should be taking that. Certainly it's been more traditionally in a feeder fund format for us here in the US market at least, but we'll dig into that in a little bit. I think as I kind of look at the landscape today, I'd be curious to hear from each of you, what's your firm's focus on private markets right now? Perhaps we'll just start with you, Mark, and go from there.
Yeah, Shane, and thank you for having me. It's great to be here with everybody. Maybe just to start off a little bit more about the way our organization works. So we have 18,000 financial advisors, and ultimately those financial advisors are responsible for working with the end investors who represent about $4 trillion in wealth. So I would say the first answer to that question is we're squarely in growth mode, right? And there's two dynamics that are driving that. One is that we continue to see across those 18,000 financial advisors, there is more and more adoption each year, each month really, of those advisors buying into alternatives and looking to private markets to bolster the way that they're working with their investors. The other dynamic is more systemic, and the way that a lot of our advisors work is they look toward our chief investment office for allocation guidance. And we are increasing the allocation because what you'll find is with the individual investor through private wealth, many of them have embraced alternative investments, have embraced private markets, but really at a lower allocation than we think would be optimal. So that's certainly a driver of growth.
Mark, just as a follow-up there, what is the recommended percentages today at Merrill?
So it's going to range based on the client's profile, of course, but we're talking to alternative markets somewhere between 27 and 40%. Now, in terms of area of opportunities that we're looking at specifically, I'll start with a bit of a non-answer, which is when we work with our advisors, we really instill that there's a necessary discipline to be a successful private markets investor. Right? And that goes across diversification of approach. It goes across consistency year after year, having the discipline to allocate, because that's what you need in order to get your allocations to a place where we think you'll be a long-term successful investor. And that pulls through to how we originate or source as well. So we look to make sure that when we're thinking about what funds we're bringing to market in any given year, we're providing diversification so advisors can maintain that discipline. So recognizing that's a bit of a non-answer, I'll give a bit more specifics. We think we're in an environment now where we're going to see...
By the way, your compliance department would love the non-answers.
Yeah, that's right. I'm well trained.
Yeah.
Rates higher for longer. We think that supports opportunities within private credit. We think there's going to be some residual inflation for some persistent period of time, so we think the importance of allocating to private real assets and infrastructure is interesting. And then we also believe that there is really pent-up demand for M&A, a lot of dry powder that's still on the table. So we think that the environment for buyout should be interesting in 2024, and that will attribute to buyout funds that were raised in prior years, but it also creates a very interesting market for secondaries.
Jeff, I've been spending some time with your new head of private wealth over at Citi, Andy Sieg, who's known to many on this panel. What's going on over at Citi? What's the plan around private markets today?
Yeah, it's funny. It's really hard to be part of a conversation that doesn't talk about growth and wealth. It's a continued echoed sentiment, and it's no different at Citi. So with Andy joining, In Andy's background, Citi is continuing to ramp up our alts business. Our alts business today is a $30 billion business plus unfunded, and we're going to continue what we have always done historically in the alts business, and that's focusing on about 18 to 20 primarily closed-end funds, and then continue to add to the platform in various ways and forms. I would say more so from a offering perspective, just following up on Mark, heavily focused on some of the center plate products, whether that's buyout growth, some things in private credit, a couple things in the opportunistic space, going after some opportunities, particularly investing in the private markets in GPs, and then maybe something a bit more thematic, and I would say that's digitization and healthcare, some areas of focus for us. From an allocation perspective, what's interesting, and this is sort of pre-Andy, the focus of putting a percentage of a client's portfolio in alts is front and center. And I haven't seen that in 13 years at Citi. And that's not a lack of Citi not trying to focus on alts, but what that is a continued evolution of the industry, the focus on alts, and putting in exact, basically a thumbprint on a client's portfolio of what that recommended allocation is. It's definitely double digits for us, just in illiquids. You start to add in hedge funds to complement out an alternatives portfolio, and that starts to grow materially bigger.
Michael, I'm going to say that you're the RIA representative and not just the Mariner representative here today. So what's happening in that channel?
Yeah, a little bit different than my colleagues on the panel, but would echo a lot of their sentiments in that, my role is to provide investment optionality for our advisors and clients. And so what that means to me is, build out a diversified platform across asset classes, across sub-strategies, across risk-return premia, across investor qualifications. So we, like Mariner, has 1,400 advisors that have a wide range of clients from accredited investors or even non-accredited, mass affluent, all the way up to ultra-high net worths. And so I have to serve, in my role, I have to serve that broad client demand and ensure that we have investment optionality for that range of client base. In terms of kind of what that looks like or what we're thinking about on a go-forward basis, I'd echo some of the comments here around higher for longer, around kind of a return to normal from a private equity standpoint in terms of M&A. The other thing, I guess, to piggyback on that a little bit, is thinking through differentiation from a GP standpoint by being a solutions provider. And I guess what I mean by that is, secondaries serve as a liquidity solution. So that is really interesting to us, both on the GP and on the LP side. Opportunistic credit that can go into help what we think is going to be a little bit more of a distressed environment from a credit standpoint globally, and be a solutions provider from a financial standpoint. That's something that's pretty attractive to us right now. So thinking through those variety of different, how do we build out both a foundational exposure for all investors that Mariner, or all clients that Mariner serves, and then maybe add on some more interesting solutions type funds that are going to serve the ultra high net worth channel that Mariner serves as well.
Perfect, thanks. Ahead of time in the green room, I love to name drop, by the way. We were there and Blake Griffin was there, and I felt the need to talk to him. He did not feel the need to talk to me. But I was just relieved that he wasn't going to be competing against us. He had actually finished his panel, and I could see Eli Manning in the distance, and he had finished his panel. So as I look out here, I realized that the numbers probably would have been a little lower if those two were on opposite us. But I did pitch this next question to Blake, and he wished me all the best. He thought it was quite dull. But perhaps we can make it a little more interesting here. When we think about this evolution, which has gone from being in feeder funds now towards these more semi-liquid evergreen perpetual vehicles, something at Carlyle we're spending a lot of time on in various geographies, and there's a lot of market demand as we kind of go from the QP world down to the accredited, and what that all means for us in terms of making sure we're recognizing our investment capabilities and putting those institutional capabilities into a evergreen structure for the wealth channel is something we spend a lot of time and effort on, and obviously we've been doing a lot in the interval fund space in particular in recent past here in the US market at least. I'd be curious to get all of your perspectives on on the kind of the evolution of semi-liquids, what's going on there, what's the value proposition, and kind of do you think they really are additive to a client's portfolio? Perhaps we'll start on the other end with Michael.
I mean, we certainly think they're additive to the client portfolio. I think they're a great not to sound like a broken record, but it creates accessibility for lots of Mariner clients that didn't previously really have access to the private investments world. And I think, frankly, it's interesting, kind of turning the question on its head a little bit. In some of the asset classes, I think it really puts pressure on some of the drawdown structures and the drawdown firms to say, what's the value proposition in a private credit fund of a lockup vehicle? What's the premium you're getting for a lockup vehicle as opposed to evergreen? And does that make sense for most investors or most clients? And I think, in a lot of times, the answer to that is no. So we view them as a great foundational exposure. It's kind of a dangle your feet in the water, so to speak, for investors who are looking for their first alts exposure. That's a great avenue for, it eliminates a lot of the friction, a lot of the complexity around private investments investing for Mariner clients. So we think, in real estate and private credit in particular, a lot of the different GPs, as you know, have come out with evergreen private equity structures. We're looking at a lot of them to kind of determine, is that a fit for our platform? So we certainly think that they're here to stay. Maybe the last comment I'll make is that a lot of that demand is not even coming top down, it's coming bottom up. I think they have become more ubiquitous in the market from a client standpoint or a client knowledge standpoint. And so you're hearing that from the client base saying, hey, I saw that, Carlyle's launching a new private equity evergreen fund. Are we going to have access to it? It sounds really interesting. Hey, I saw that such and such private credit fund was out and, just announced that they're raising their distribution. So it's becoming more ubiquitous in the market. So you're getting that kind of bottoms up demand for that product as well.
Appreciate that you called it such and such fund, by the way.
Yeah, there's a good plug on Carlyle.
Yeah, I'm on brand. Right?
I think in terms of the semi-liquid evergreen industry, we're still early stages. I think there's still a lot of adoption to go. We are very positive on it. So from a platform perspective, we only have a handful of those funds on the platform. We want to be in a situation by the end of 2024 where we have substantially more. That's a big project and initiative for us. We're seeing scenarios where it's not just a lower level AUM client. We are having a lot of private bank clients access those funds because of the potential liquidity. They are semi-liquid. They're not fully liquid, but they're semi-liquid. And so I would almost think of those strategies in many cases as fixed income alternatives. Whether that's right or wrong, that risk return profile associated with that type of product and that liquidity is probably the best way, in many cases, to position that. The other thing I would add, just in terms of the industry itself, many of our clients, whether that's lower AUM clients or private banking clients, they can't really manage capital calls and distributions. So if you have a product day one that gets 100% called, is put to work, and you maintain long-term discipline on that product, the IRR is still, low, high single digit, low double digit. I will put my caveat hat on. But the return multiple, the equity multiple associated with that, because the capital is outstanding consistently, can have the chance to outperform a private equity portfolio that's not managed appropriately. And that's a big part of the discussion and dialogue with our labs department with a number of clients in terms of how to consistently better optimize your private equity portfolio. And this is a tool to do that.
Yeah, I think Michael and Jeff hit on a lot of the key points there. And short answer is we are embracing it, and with a very deliberate and I think measured fashion, in the sense that when you start putting private assets into semi-liquid vehicles, right, I think there's another layer of diligence to make sure that the asset liability and expectation training is all set right. What's really resonated with our investor base, because it's been tremendous, the amount of interest that we've seen, is just I think it's less on the back end around liquidity and really more on the front end of having a shelf product that you can get familiarity with and scale across your book in a way that is consistent. The experience is consistent, and it gets to the point around managing a drawdown private equity portfolio, it does take a bit more discipline and complexity. So that has resonated very well. We certainly don't think it's a replacement. We think more of it as a complement. And we also see that it's not just, I mean, it is certainly a great tool for building a portfolio with a lower starting investment base. But we think it can be a great core to some of our larger investors that are using that and building around it with drawdown private equity funds to complement it. You know, the last thing that I'll touch on, just tying it back to my first comment, is the challenges that we think about with private markets investing goes back to the earlier point around making sure that you're consistent around diversification and coming back every year. The perpetual structure solve for that in a lot of ways, right? Because you're getting that built into the structure, which is a great bonus as well.
I think, yeah, go for it.
Yeah, maybe one other point I would make is that for me, like for where I sit at Mariner in the RIA world, it's kind of a force multiplier as well, because like, you know, Shane has a distribution team or a Carlyle team that's going to go out and talk to all of our advisors and answer questions. And not the drawdown, you know, that they serve that on the drawdown side as well, but the fact that it's constantly in market, constantly available, you know, it just creates socialization the way that a drawdown fund doesn't within the RIA space. And I think that's really important as we think through how do you move advisors from not allocating to alternatives. You know, having that partnership, I think, is critical from the GP side.
Yeah, and I think that, you know, in the old construct, one was going to market on an episodic basis, raising a closed-end vehicle, leaving the market. I think from my seat, the beauty of these evergreen structures is we have the Carlyle brand in market at all times. We're telling the story at all times. So it probably saves us one meeting when we then come even back out with another closed-end vehicle on that platform. I think that lends itself, you know, this conversation of going from QP to accredited lends itself obviously to the next topic around education. I was in Japan last week, and you know, every meeting after a lot of back and forth with business cards, which is takes a while, but we got there. I learned quickly how to do it. But at the end of that process, we started talking, the first topic was education. And no matter where I go in the US or globally, education is front and center. And I think that the challenge, when I think about some of my colleagues in the room perhaps, might be, if you're at a small to medium size shop, how do you compete perhaps against the larger firms that have universities put out, they're investing an awful lot of money in this market. We're looking at technology. We obviously have the ability to kind of scale up our education effort in a meaningful way. But I'd be curious to hear maybe best practices. We'll start with you, Jeff, maybe best practices around education and where you've maybe seen some folks kind of do it in a smart way that's kind of scalable would be kind of interesting, I suspect, for some folks out there.
Yeah, I mean, again, very topical. So I was just following up on some points on education just with email traffic this morning, a couple different GPs in terms of their education philosophies, how they're educating other clients from a PE alternatives perspective, and then how do we deal with it internally in terms of our own education and then that proper mix. What I would say is we're struggling to kind of find that right balance. And what I mean by that is it a alternatives 101? And I would say most of the bankers or investment counselors know the 101, but then is it a 102? And what's in the 102, and where's the level of basic understanding in a level 2? And do we do level 3, level 4? So you can see in terms of it's not only education, but it's content, in delivering the right content, the right timing associated with that content, different levels of content that we're actually trying to figure out right now. I think that will evolve, and I think as an industry that's evolving right now, and I think there's a lot of good things that are coming out from an education perspective, but how you get to that, whether it's a financial advisor, banker, or investment counselor, deliver the tailored solution that they need in terms of more education, in terms of an industry perspective, how an evergreen works, what are some of the nuances associated with an evergreen, and getting that to them is all very key.
I think it's all of those things, right? I think it's the 101, it's the 102, it's the advanced level courses, because particularly in our seats, right, we're facing off with a very broad group of advisors and investors that are at different parts of their educational journey. So the fundamentals is something that we've never lost sight of, and I think that is key. But to your comment, Shane, we've recognized in recent years that because of this tremendous focus now from the GP community in private wealth, we have a lot more resources to dip into in terms of furthering education. And it's not just the universities and the due diligence academies, but it's also coming from different levels. There's no monopoly on good ideas, and we think that there's tremendous amount of white space to continue. In terms of how we've evolved our model a bit, we're kind of trying new mediums to be a bit more interesting. So we just released a video series called Let's Talk Alts that's available to not only our advisors, but clients, prospects, general public. And we have access to such tremendous thought leaders, really bright minds in investing. So we said, why don't we bring that to our advisors as a resource? So we do short kind of videos that are thematic, and we're continuing to build that out. It's resonated well. You guys can Google it if you're interested. The other thing I would say, and this probably goes to your point around a small shop, is like be thematic, right? There is a subset of advisors and investors that is interested in understanding the weeds on infrastructure, but many more are dealing with much more topical conversations about inflation, geopolitics, what about correlations between fixed income and equity? So if you start from a topic that is relevant to everybody in the conversations that advisors are having with the clients, that is much more translatable to the end message around how alternatives can be a tool. And that's really one of the themes that we're leaning into this year, is we're trying to bring alternatives away from this island that, we are something you need to elect into and think about, to just talking about core investing and talking around the spectrum of investments that we can deliver. An alternative oftentimes fits in there, right? So we're trying to be a little less pushing alternatives and more just talking about how alternatives can be part of the spectrum.
Yeah, maybe the only thing I'd add to that is, or I think Mark mentioned, equipping advisors with intelligent information that they can then bring to clients. Like the education that I think works the best at Mariner is both when it's bringing the advisors along and kind of helping them move up the learning curve or get more familiar with the product, as well as giving them the relevant talking points, the relevant information that then they're going to need to bring down to the client level, so that removes a lot of the, removes some of the friction from the process. Because, honestly, when I think about education, it's not necessarily like advisors are thinking through, well, do I allocate to Carlyle or Blackstone? It's, do I allocate at all? Like the easiest thing often for advisors to do in alternatives is to do nothing. And so how do you motivate, how do you equip them with the information, whether it be technology, education, the resources, the investment funds, so just like the fund in general, to motivate them to transact? And that's what I think about on a day-to-day level in my job, but education is a huge part of that.
Got it. So, at Carlyle, we've spent on our first iteration in the wealth business, we spent a lot of time with our semi-liquid vehicles in the credit space. And as I kind of think about the market, and for folks out in the room here today, it seems like a lot of the oxygen has been taken up by private credit. And I'm curious if you think we're coming close to a moment where private equity is gonna bounce back, or kind of if you have a view on that, if you're starting to see a turn, or if you kind of think private credit is gonna still dominate for a period here. Perhaps we'll bounce that to you first.
Yeah,
maybe a 1 minute answer on this.
It's a good question. I don't think those two things are mutually exclusive. I think there's a lot of room to grow for private credit, because to what I mentioned earlier, you're seeing that there needs to be a new playbook for fixed income because of how rates have changed, an environment that many investors have not seen in a long time. So we think the private credit is here to stay and there's room for growth. But yes, I think that the interest that we're seeing across private markets, traditional private equity, we certainly believe that is coming back in the cycle in a cyclical way. And one of the dynamics that we monitor is that we have investors that are at near peak positions in cash holdings, cash to cash equivalents, because of where yields are at. So if we have, let's say, 20%, 25% held in cash, and that money's coming back into market, there's a real opportunity for private markets, traditional private equity, to be a beneficiary of that.
I would just say private credit has been top of mind, I think, for a number of our clients for the past 12 to 18 months. I'm starting to see it shift a bit. I'm starting to see a focus with the potential of rates dropping in the second half of this year. Our strategic return estimates for private equity are probably at an all-time high. I think they're a little over 19% right now on a 10-year outlook. So the focus on our end continues to be on private equity, and I think you'll see that shift over 24.
Yeah, I would echo what's already said. I guess with the one caveat that when we're looking at private equity, like we're really focused on value creation, and the ability to grow businesses organically and inorganically, and having that capability in-house. So, private equity, we think private equity is going to be very attractive in the current and coming vintages. But we also we need to be able to see the ability of the firm to create value in their portfolio, and not just rely on a rising market or rising multiples as the source of their returns.
When I think about the journey we're all on in this room around private markets, from a Carlyle perspective, I think the next 12 to 18 months will be kind of around the co-investment secondary space for us here in the US market to a large extent. When I think about each of your firms, in under 30 seconds, I suppose, what's the pending journey here for you at your shop for the next 12 months?
Yeah, I mean, I'll start in that private investments in our platform is a little bit newer at Mariner, and so my role over the last 2 years has really been to build out a comprehensive platform for alts. I mean, we're still, the analogy that I like to use is like we're flying a plane and we're still building the wings and the engines on it, and that's an interesting role sometimes. So I think we're still very much in the looking to expand and grow in all directions as it relates to alts, core foundation as well as larger or nichier fund ideas.
I would echo the comments just in terms of balance and investment for client portfolios. A couple of the areas I would just highlight again that I had mentioned early, particularly on the equity side, whether that's lower to mid-market buyout, growth type opportunities, and we're even adding some venture capital opportunities. So almost in some cases a little bit more risk on, given in terms of the vintage year where we are and where the potential opportunity, that we're going to be setting up for growth for the second half of 24 and 25.
Yeah, our alternative investments business has been around for now over 30 years, but that's not representative of like how our investors and advisors have been doing it. So I would say our key themes are broadening the base, right? Simplifying the narrative to bring the product closer to the end investor. And one of the benefits of this overlap and the reason that we're on stage together is that we're getting tremendous access and structures and strategies that really fit the needs of our clients. So making sure that we continue to raise the bar of the products that we're delivering as we grow.
Perfect. Well, on behalf of the panel, I want to thank all of you for coming. And to my fellow panelists, I really appreciate your comments today. Thank you, everyone. Take care.